Good evening, everyone. Thank you, Oliver and Mike, for the wonderful introduction. I just met Oliver today. I've known Mike for over 20 years. I met him in Reykjavik. We were dining at a restaurant at a high, tall building that revolved around, we could see the whole town. And serendipitously, I was put at the same table with Mike. And during our conversation, he mentioned he had a wonderful idea to see the whole world, which was to just get up in a balloon, hover up there, and let the world pass below him. And I knew then that Mike and I were going to be great friends forever because we have similar crazy ideas about things. Mike also mentioned I have 64 co-authors. I think that's a laudation or not, depending how you think of it. If I told you I had had 64 wives, you might question my ability to commit to a relationship. Well, anyway, it's a very special honor for me to be here today to give this lecture for several reasons. First of all, yes, Richard Musgrave wrote the theory of public finance while he was a professor at the University of Michigan. It is also true that the first graduate class in public finance I had at Harvard, the instructor was Richard Musgrave. He was an inspiration to me then and thereafter, in particular because of his belief that economics could serve a higher purpose. Second, the title of the research I'm going to talk about today, which I call Tax Systems, was inspired by Richard Musgrave's second great book, Fiscal Systems, which introduced the concept of tax handles and stressed the importance in the development of taxation over history of the administrative and compliance challenges in tax collection. And it's a special privilege to be here in Munich because this is the site of the wonderful debate between Richard Musgrave and James Buchanan over the role of the state, which was published as a book, Public Finance and Public Policy, Two Contrasting Views of the State. He was also a wonderful man of warmth and integrity. Those of you who knew him will remember that for a long time he had very serious myopia. And after I left Harvard, he had an operation, and I remember seeing him for the first time after his operation at a meeting of the American Economic Association. When I saw him, I stopped and said hello, and he looked at me and he said, "Oh, that's what you look like." So I'm going to, okay, so to get to my slides, I was instructed to click on PowerPoint, but I don't see it. So I need, not a professor of technology, apparently. Okay, all right. So what I want to talk about today, Insights from a Tax Systems Perspective, is based on a monograph I just completed with the title Tax Systems. It's co-authored with Christian Gillitzer, who is a PhD student at the University of Michigan. The book is completed in draft, but we haven't got the galleys yet, so any comments or insights you want to send along to us, it's not too late for it to be of great value to us. I want to begin my lecture by discussing a variety of tax phenomena, some more important than others, but that fall under the purview of a tax systems approach, which I will define precisely soon. First phenomena is a new type of motorcycle with 3 wheels and long benches at the back, seating up to 8 passengers. That was introduced after a high tax on cars, the idea being that a car-like motorcycle would not be subject to this higher tax. And second phenomenon in this group is a redesigned panel truck with glass windows instead of wood panels and upholstered seats in the back, also designed to avoid a high tax on cars. In this case, this still came under the taxation of trucks rather than cars, although it got to be very car-like. Income tax is based not on income at all, But, for example, for restaurants, the square footage of the seating area where the tables are and the number of tables. Simplified tax rules, or no tax at all, levied on businesses below a certain size threshold. The commissioner of the IRS in the United States testifying before the committee that makes it the appropriations, that an additional dollar added to the IRS budget will actually generate $7.30 in additional revenue, so that therefore appropriating another dollar to the IRS will therefore decrease, not increase, the deficit. Tax experts declaring a value-added tax as a self-enforcing administrator's dream, while deriding the textbook equivalent retail sales tax as not acceptable under usual standards of equity and intrusiveness. In the United States, the self-employed remit only 43% of their actual tax liability, while wage and salary earners remit 99%. U.S. corporations making substantial real investments in Puerto Rico, territory of the United States, in electronics, pharmaceutical, and high fashion production, not generally considered activities in which Puerto Rico has a comparative advantage. I close with this one because it's part of our family history. Many years ago, my family went to Puerto Rico for a Christmas vacation, and on the drive from San Juan Airport out to where we were staying, I gave a lecture to my children about how they should pay special attention to the kinds of companies they see on the highway between San Juan and the condo, and having them note it was electronics, pharmaceutical, and high fashion production, and challenging them to think about why it would be that these kinds of companies were here. Those of you who have children will know that they were not the least bit interested in this challenge. And we're still not interested when on New Year's Day, as many newspapers are wont to do, when they had a story about the top 10 issues in Puerto Rico in the previous year, I showed them that the pending elimination of the special tax breaks to Puerto Rico was the #1 story. That also didn't impress them. I want to claim today that our standard models of taxation struggle to illuminate these examples and to provide policy guidance about them. Some, of course, are more important than others. But why is it that our standard models struggle to illuminate these tax phenomena? And I want to talk about that as limitations of the standard toolkit. Now, what I mean by the standard toolkit is the kinds of analyses introduced starting in the early 1970s by people like James Mirrlees and Peter Diamond, modern optimal taxation theory, and the econometric work that went with it. There is no question that the modern approach to public finance was a tremendous improvement over what came before, with Richard Musgrave's work really setting up this next accomplishment. And it replaced what was largely unrigorous reasoning with a kind of rigorous reasoning that really allows science to progress. Nevertheless, like all models, there are limitations. So let me talk a bit about what I see as the limitations of the standard toolkit in addressing the tax phenomena I've already discussed and other issues. First of all, the standard toolkit pays little attention to the administrative and compliance costs of taxation. This is actually a step backward from the work of Richard Musgrave, who, as I mentioned in his book, Fiscal Systems, stressed the importance of these aspects of taxation. A focus on tax rates and, to a lesser extent, tax bases, to the relative exclusion of all other tax system instruments, such as enforcement tools, the audit rate, who to audit, loopholes in the tax system, whether tax liabilities ought to be disclosed publicly or not. There's actually a host of important other aspects of a tax system that has gotten relatively little attention in the standard modern taxation framework. A focus on what might be called real behavioral responses to taxation, such as labor supply and saving, to the relative exclusion of avoidance and evasion responses. I'll certainly come back and talk more about that. The modern optimal tax literature certainly recognized and actually made it clear that of the essential role of asymmetric information between the government and private citizens, but in the early years made extreme assumptions about what is measurable without cost and what is not measurable at any cost. Think back to the Murley's optimal income tax model, where the assumption is that income could be ascertained costlessly by the government, but either ability or hours worked could not be obtained. Information about either of those could not be obtained at any cost. Of course, the world as we know it lies somewhere in between. No meaningful role for firms. For the most part, the modern models of optimal taxation assume constant returns to scale in production, and therefore we don't know how many firms, or one firm or millions of firms. It doesn't matter, and therefore implications of heterogeneous firm size can't be explored. No concern with the details of tax remittance. Mike foreshadowed that some of my research has been about that. Tax systems don't administer themselves. There needs to be a remittance and collection system. And as I'll say in a minute, the textbooks of intermediate public finance have a folk theorem that the details of tax remittance matter not at all, and I think that is just not true in many cases. I will argue this evening that a tax systems perspective can provide insight into these and other important issues and can help us to get past the limitations of the standard toolkit. So I need to tell you now, as soon as possible, what I mean by a tax system, so you can understand what I mean by a tax systems approach. So here is exactly what I mean. A tax system is a set of rules, regulations, and procedures that does three things. The first thing it does is it defines what events or states of the world trigger tax liability. And that one might think of as tax bases and rates. And of course, this is the emphasis of modern tax analysis. But a tax system must do two other things. It must specify who or what entity must remit that tax and when, called these remittance rules. So this is, for example, whether a tax on labor income must be remitted by the employer or by the employee. And finally, third, it details procedures for ensuring compliance with 1 and 2, including information reporting requirements and the consequences, including penalties, of not remitting the legal liability, and we'll call those enforcement rules. So a tax system is a set of rules, regulations, and procedures that lays out all three of these things. Now, as you might have gathered from my discussion of the limitations of the standard toolkit, the standard analysis, with some exceptions, of course, presumes that tax liability can be ascertained by the tax authority and collected costlessly. And if that's true, Statement 2 or Part 2 of a tax system is irrelevant, and Statement 3 is unnecessary. So what I want to do next is talk about how to build a framework of tax system analysis that encompasses these three things and can address the following things. It can address the fact that although some individuals, myself included, may remit their tax liability dutifully, others view compliance as a tactical decision and will evade their liabilities if the odds of success seem favorable. Taxpayers will rearrange their affairs to legally reduce their tax liability, including efforts to reduce their tax liability without altering their real activities, such as labor supply, the consumption bundle they take on, which I will define in a few minutes as avoidance. Limiting avoidance and evasion by the tax authority is costly, and tax authorities have limited administrative resources. Tax authorities have multiple instruments, as I mentioned, but they are limited. Taxpayers and tax policy makers, for sure, have cognitive limitations. I will not spend time this evening talking about that. And finally, the world is complex, complicating the collection of non-capricious taxes. The word non-capricious is important here because if the tax authority and government are not concerned about the equity with which taxes are raised, it could collect taxes in a much, much less costly way, just by randomly or in the most easily way assigning tax burdens to individuals and firms. Some of the complication is admittedly manufactured by taxpayers to obfuscate their affairs, but some exist because the tax system, most tax systems, are used to achieve specific social goals in addition to raising revenue, making the process more complicated. So what am I going to do with the rest of my time? I'm going to talk about how a tax system approach takes seriously multiple behavioral responses. It takes seriously multiple sources of cost, and in a minute you'll realize I don't do these in exactly this order. It recognizes there are multiple tax instruments, and it summarizes much of what we know about the behavioral response to taxation with a tax-based elasticity. And I want to talk a little bit about optimal tax systems. Once we recognize the aspects of the standard toolkit and of the world that have been relatively ignored, we have a number of fascinating new normative questions. First of all, we can look at the standard tax instruments, rates and bases, and rethink how to characterize their optimal setting in light of avoidance and evasion. Second, now we have a whole host of new tax instruments, and we wanted to see how we can apply normative analysis to think about the optimal setting of these new instruments. And the last thing I'll say is I'll talk a little bit about implications of the information revolution, and the reason I will is that the optimal, the modern taxation approach emphasized that at its core, taxation is a problem of information. It's an issue of information. We're having an information revolution. We're in the middle of it. So it just stands to reason that this is going to have profound effects for taxation. So I'll talk a little bit about what they might be. Okay, so first I'll do multiple costs, and first let me talk about administrative costs, which Richard Musgrave spent a lot of time thinking about. As I said, collecting taxes, especially non-capriciously, requires a costly bureaucracy, in part because we need a payment and collection system. And for any given objective that a tax authority or government might have, there are more and less effective ways for a tax administration to operate. So here's just some questions that arise. What is the optimal use of computers and information technology? I'll come back to that. Should a tax administration be organized by tax levy, so have a corporate tax division and a value-added tax division, or by taxpayer segment, corporations and all the taxes they're liable to versus high-income individuals and all the taxes they're liable to? How should it be organized to minimize corruption? There's no question that there are important procedural differences between tax systems, which include the degree of self-assessment, the extent to which income withholding at source is used, and the amount of arm's-length information reporting on tax liabilities to the tax authority. These are critically important aspects of tax systems which differ markedly across countries. And I believe that we as economists have spent too little time thinking about how to analyze the consequences of these different systems and how to think about applying our normative frameworks to these issues. It's also true that market transactions facilitate administration of non-capricious taxes, because a legitimate government which wants to levy non-capricious taxes prefers to have the basis of tax be measurable and observable to other parties. Market transactions facilitate that. And then at the bottom of this slide, I have the first of many cryptic non-sentences. Modified coasts, I will tell you what I mean by that. Ronald Coase wrote an article many, many years ago about the border between firms. And he talked about what firms think about in expanding. And he characterized, non-technically, but characterized the equilibrium distribution of firms. And in his model, I think what he intended to say was that the equilibrium distribution of firm size was also the optimal distribution of firm size, because firms take into account all the social costs in deciding to expand or not. Okay? I believe that's not true once we have to raise taxes. And the reason is because market transactions facilitate non-capricious tax administration. Now suddenly the boundary between firms is not a matter of indifference to the efficient operation of the tax system. In the extreme, if there were one firm, one big firm, it would be very difficult for the tax authority to get any information. There are no market transactions between firms that they could use to ascertain tax liability. At the other extreme, if there were millions and millions of very tiny firms because of the fixed costs of dealing with firms, that would also be not optimal. So I believe an unanswered question is, what is the optimal distribution of firm size now that we understand that market transactions facilitate tax administration? So I hope someone in this room writes the paper on the modified Coase version of firm size. Administrative cost is a function of the physical size of the tax base, its tangibility and visibility, its mobility. It's certainly, for example, harder to tax diamonds than windows for technical reasons I won't go into. Whether there is registration of the tax base for non-tax reasons, such as owners of cars, the number of tax units, as I suggested, the extent of information sharing with other agencies. In the US, other federal agencies cannot get access to the tax data that the IRS has. I know that's not true in other countries. Administrative cost is also an increasing function of the complexity and the lack of clarity of the tax law. Administrative costs tend to be discontinuous and have decreasing average costs with respect to the tax rate. There's a lot of fixed cost to putting in a new kind of tax. Think about introducing a value-added tax in the United States. It probably doesn't make sense to do it unless we do it at a certain high level of tax rate, because the average costs certainly decline with the tax rate. And this suggests that if you just ask the question, how many different taxes we should have, each with a fixed cost, this last characteristic limits the optimal number and suggests casually that every country in the world, including the United States, has way too many different taxes. Okay, next, compliance costs. These are costs borne in the first instance by the taxpayers themselves. For individual income tax, it's the time you put into your income tax and the money you spend on books to teach you how to avoid taxes and hiring an accountant. All the empirical work suggests that compliance costs dwarf the administrative costs. For the US income tax, my best guess is that compliance costs are 10% of revenues. Administrative costs are about 0.5% of revenue, so it's compliance costs are 20 times higher. In the United States, the commissioner of the IRS every so often writes an op-ed in a major newspaper talking about how efficient the US tax system is. And guess what? The commissioner always emphasizes that 0.6% number and doesn't say much about the 10% number, because they write that, well, the dollars raised per dollar of the IRS budget are, about 200. But if you include the compliance costs, which are about 20 times higher, it is a lot less efficient than that. The burden of compliance costs may be shifted just the way explicit taxes can be shifted. If you put a lot of compliance costs, say, on firms, that will be built into their price structure, just the way a tax system would be. So we shouldn't conclude because compliance costs are in the first instance borne by someone that in general equilibrium they are. And keep in mind that administrative costs also ultimately burden citizens, even though in the first instance they show up as government expenditures. How do we know that compliance costs are about 10% of revenues versus 1/20th for administrative costs? They're generally measured using surveys, and it's not perfect. You can imagine biases going both ways in surveys' compliance costs. After all, a survey is not that dissimilar from an actual tax form, so the people who will fill in the surveys are probably not a random sample of how people deal with compliance costs. On the other hand, you might imagine that some people want to overstate their compliance costs in the hope that somehow their message, their cry about how complicated the tax system will get through into the analysis, and that will cause the government to change its policy. There are a lot of difficult research questions that I'll just mention tonight. How to value the time spent. It turns out most of the compliance cost isn't out-of-pocket expenditure, it's time. How do you value people's time? Undoubtedly, some of the compliance cost is involuntary. You have to do it to comply with the law, but a lot of it is tax planning that people do in order to lower, legally or illegally, their tax liability. From the point of view of society, all of these are resource costs, so I don't think it is critical to separate those two. Which costs are truly marginal is tricky, especially for businesses. After all, think of a small business. Having to deal with an income tax forces the business or the accountant of the business to think about many aspects of the business operation, may make them aware of things they weren't otherwise aware of. So that's not a social cost. And same is true for individuals. What value, if any, does addressing one's financial affairs provide? There could also be spillovers. In the United States, to get a mortgage, you have to provide your income tax return, not because they're so interested in your tax liability, but it's a relatively reliable measure of income and therefore indicator of your ability to repay the loan. And there are many trade-offs in administrative versus compliance cost. The businesses already have existing expertise related to financial affairs. Administrative costs are, in a sense, more transparent, since I can look them up in a budget statement, at least in the US. And they have a differing shadow cost, because administrative costs come after tax revenue is raised, and so the society incurs the excess burden and other costs of raising the revenue. So there's a higher shadow cost for administrative versus compliance costs. So as I said, tax systems take seriously that there are multiple costs. I've talked about that. There are multiple behavioral responses and multiple tax instruments. So now let me talk about multiple behavioral responses. Now, it's certainly not true to say modern tax analysis is not taken seriously, tax evasion. The pioneering paper of Allingham and Sandmo, which is now over 40 years old, has certainly framed how we think about the positive decision of whether and how much to evade taxes. Non-deterrence theories, the Allingham-Sandmo model being a deterrence model. People restrain their tax evasion because they're concerned about the possible detection and penalty. That's a deterrence theory. Many non-deterrence theories have been proposed that people comply with taxes for patriotic reasons, for dutiful reasons. They care about what the government spends the money on. They care about the process in which taxes are collected. But in my own view, there's not a whole lot of empirical support for the non-deterrence theories, although there is clear and abundant evidence that deterrence plays a major role in people's and businesses' choices about evasion. Empirical analysis of evasion is challenging. One of my colleagues many years ago made the following statement, which I've put as a footnote in probably every paper that Mike mentioned. And what he said was that empirical analysis of tax evasion is straightforward except for two things. You can't measure the right-hand side variables. You can't measure the left-hand side variable. So what that means is it's challenging. And when my students talk about problems in their work, I say we talk about challenges, not problems. And so it's challenging, and there's a tremendous reward to creative ways to think about empirical analysis of tax evasion. Let me mention two promising developments. One I call the traces of income approach that, with Caroline Weber, I wrote about excuse me, in the IIPF lecture I gave in Uppsala a couple years ago. And examples of this are, this is a different Weber, the paper by Pissarides and Weber, which look at the differing relationship between reported income and food consumption of employees and self-employed people. Learning from the fact that the ratio of food to reported income is much higher for self-employed people, and reasoning that that is not because they eat more or less, but because they report less income. My co-author Naomi Feldman and I went on from that approach to do a similar sort of thing using tax return data, where we used charitable contributions rather than food, and found, lo and behold, that the ratio of charitable contributions to reported income is also substantially higher for self-employed people, and with some assumptions we can back out what their compliance rate is. Another promising new development is randomized field experiments. I did one in Minnesota many years ago, but it's really hot now in many fields. Henrik Cleven and co-authors have done fascinating work in Denmark, Dina Pomerantz in Chile, and Fellner and co-authors in Austria. Now, sometimes I despair when I see the wave in the credibility revolution toward randomized field experiments as the gold standard for making credible inferences. And the reason I despair is I just don't think we're ever going to convince governments to randomize their tax rates among the population so we can learn what the effective tax rates are. I just don't think it's going to happen. I don't think they're going to randomize the tax base either, so I'm just not confident that as these other fields ride ahead in their golden chariot using randomized field experiments, we're going to be left behind. I get partly past my despair by realizing that governments may be willing to let us do randomized field experiments on the other tax instruments in the vector of tax instruments. Maybe not tax rates or not tax bases, but things like the instructions provided to taxpayers, the enforcement regime in place. And these randomized field experiments that I've listed are examples of this, and there's several other fascinating research projects in this area. Finally, avoidance. First of all, what is it? And that's not as easy a question as you might think, because if you ask an economist quickly, what's avoidance and how do you distinguish it from evasion, I think most economists will say that's really easy. Evasion are illegal things you do to lower your tax liability, and avoidance are legal things you do to lower your tax liability. The problem with that definition is that I think most of us would not think of reducing labor supply or changing how much you save as avoidance. We would think of that as a real behavioral response to taxation. So, question, how does one distinguish real behavioral responses from avoidance, and therefore what is avoidance? So here's my shot at a definition. Taxpayer, and this is about individuals, taxpayer efforts to reduce their tax liability that do not alter their consumption basket materially, that's not in there, other than due to income effects. We can think of many examples. Paying a tax professional to search for deductions, that doesn't go into your utility function. It hopefully reduces your tax liability. Taking advantage of tax arbitrage opportunities, slightly retiming a tax transaction to move from a higher tax to a lower tax rate, or slightly re-engineering a vehicle, a panel truck, or a car, as the examples I gave. I believe that much avoidance arises because what triggers tax liability in real countries is not real variables that go into our utility functions or Haig-Simon's income, but most countries rely on surrogate tax bases that are generally justified on administrative and compliance cost grounds. Good examples are taxes on realized capital gains. The reason we tax realized capital gains rather than what the Haig-Simon's base suggests real accrued capital gains is that it's easier. It's based on an observable marginal market transaction. The response to capital gains, all the retiming responses we see are, I think, because we use the surrogate tax base and we get avoidance. Income shifting is another example, and I think a very important example, and public finance people have not spent enough time on, in my view, is the arbitrary, incoherent treatment of financial transactions, such as debt versus equity. The tax system of financial transactions and financial flows is a mess. It's incoherent. Whenever that's true, there can be tremendous tax advantage from playing off the incoherent and inconsistent definitions. Finally, there are interactions among these responses that are very important. I already gave you the Puerto Rico example and told you how it ruined my Christmas vacation when my kids had no respect for me. So this was back when Puerto Rico had a very low tax rate, and U.S. tax law did not impose a residual tax on U.S. investment income in Puerto Rico, like it did if a U.S. company invested in another country. And the result was, as I told you, much U.S. investment in high-margin activities. This is what links together high fashion, electronics, and pharmaceuticals. They were all very high margin. The pharmaceutical research was done in New Jersey. The high fashion design was done in New York City. The software engineers were in Silicon Valley. The production was done in Puerto Rico, and depending on the accounting, it could look like the Puerto Rican activities were tremendously profitable, and therefore most of the income was subject to a very low tax rate. Now, why is this an interaction among responses? A U.S. company could only claim that most of its income was in Puerto Rico if it actually did something in Puerto Rico. Well, actually, they could get away with that sometimes, but it certainly made it easier to actually have a building there with something going on. So what's the right way to think about this? The income shifting opportunities were facilitated by the real investment in Puerto Rico, which means there was an implicit subsidy to the real investment, which I call an avoidance facilitation subsidy, because once the real investment is in Puerto Rico, then the income shifting could proceed. One other thing I find fascinating is a paper by Harvey Rosen back in 1976. It's called Tax Illusion and the Labor Supply of Married Women. Harvey Rosen thought back then that maybe people don't understand the income tax system. That's back when it wasn't so complicated, and wondered that people couldn't respond to it if they didn't understand it. So he did the following empirical exercise. On the left-hand side of his regression, he put hours worked of married women. On the right-hand side, he put the real after-tax wage, which here I mean as W times 1 minus T. He estimated this in a log-log framework. Well, if you do then a log-log framework, if you have the real wage, real after-tax wage as W times 1 minus T, you can split those apart. And the standard model presumes that the labor supply would respond identically to the W, the pre-tax wage, and the 1 minus T, the net of tax term. So he did this regression, and he wanted to interpret a different coefficient on those two terms as an indication of tax illusion, expecting that the response would be lower to the 1 minus T term. In our modern terminology, that would be a lack of salience argument, that people just didn't get the taxation. Now, first of all, he didn't find that. But that's not my point. Tonight, he didn't find that, but what's important is that in a tax systems framework, the effective relative price of a real decision depends on the avoidance and the evasion technology. The wage can't be finessed, but the 1 minus T term can be through avoidance and evasion. So you wouldn't expect a priori the response to the pre-tax term and the response to the net of tax term to be the same, even if there is no lack of salience. And so the lesson is, in general, and when a friend of mine read a draft of my book, which included a sentence like this, he said he enjoyed the book, but he also learned a new word, there it is. The lesson is, in general, one should not expect a homologous response to the pre-tax price and the net of tax term, even with no illusion. Homologous, the fancy way to say same. And this is a very general lesson, that the presence of avoidance and evasion opportunities in many cases changes the price of the real activity. So all of those of you who have been going on thinking that evasion and avoidance are for another set of public finance economists, it could be that it's very important for the real behavior that you are studying. Finally, there's multiple tax instruments, information, reporting and withholding. Let me just give you some numbers to illustrate how important this is for compliance. These are numbers from the IRS, and these are the non-compliance rates of different sources of income depending on the presence of information reporting and withholding. The IRS thinks the non-compliance rate is 56% for income sources with little or no information reporting. Now skip 3 bullets down and thinks that the non-compliance rate is 1% when there's both withholding and substantial information reporting. And it's somewhere in between for a little of the both. Of these things. This, to me, is really the best evidence of why the deterrence model explains a lot. What's differing between the income sources with little or no information reporting and the ones with substantial information reporting and withholding is that most taxpayers get that there is very little chance of being caught and penalized if the IRS basically knows nothing about their income. Think self-employed people. So these aspects of the tax system affect the probability of detection and penalty and affect in very important quantitative ways behavioral response. I'll get to the central role of firms in a second. I already talked about market transactions. That provides a natural check on accuracy because you have 2 parties involved that might have differing incentives, whether to overstate or understate the market price. They tend to be better documented. But of course, not all market transactions are the same. Cash transactions are very difficult for the tax authority to track down. And leads us to take very seriously, as the pair of papers by Gordon and Lee did, that it might be optimal for a government to provide subsidies for people and businesses to have relations with financial institutions because it makes the cash transactions more visible to the tax authority. And similar issues arise with family firms. Family firms, especially in developing countries, may make up for the lack of good legal institutions. You can trust your brother more than a stranger, and that becomes very important if the legal system is not that good. On the other hand, your brother might be useless at the business that you run, so there's a trade-off in how much to involve your family and a firm, and this work I'm doing with my student Wojtek Kopczyk is trying to formalize the role of taxation and lack of trust in legal institutions with family firms. I want to talk a little bit about a tax instrument that I've been working on recently. This is public disclosure of tax liability. This was U.S. policy in our first income tax in the Civil War, our short-lived income tax in the Civil War of the 1860s. It was again policy in the 20s and 30s in the U.S. It is currently policy in Norway, in Sweden, and Finland. And it was policy in Japan for many years until 2004. It is a serious proposal in Australia right now to require public disclosure of aspects of corporate tax returns. I have a student from Australia who used to work at the Treasurer's office there, and he told me it's more than 50-50 likely that soon in Australia aspects of corporate tax returns will be public corporations will be public. Why is this a good idea? Supporters say it reduces tax evasion and avoidance. I mean, if my income tax liability is public and my neighbor sees my Bugatti in my driveway and looks up and sees my income is $20,000 a year, my neighbor might be inclined to mention to the tax authority that it doesn't seem like I could afford a Bugatti on my reported salary. It might also improve the transparency of tax policy. I think this is what motivates the Australian proposal. And opponents decry the loss of privacy from such a policy and the negative attention brought to the affluent. There are certainly stories in Japan that people whose reported income is high were hassled by any number of individuals and firms. It's related but not the same as a story I heard about the country of Colombia, which is that there was a lot of tax evasion by high-income people. But the story I was told is that it was not in order to reduce their tax liability. It was back in the days when rich people were kidnapped. They were afraid that the information about their income would get from the tax authority to the kidnappers. And they didn't want to be a target for kidnapping. I have no empirical work to say which of the two is more important. What do we know about the consequences of public disclosure? It seems less than optimal to have a public policy debate when we don't know anything about its consequences. So I have, in the last couple years, been working on two empirical papers, one about Japan and one about Norway. I'll just tell you briefly what we did and what we found. So in Japan, the disclosure regime was both for firms and individuals, but it had a very special aspect, which was the disclosure was required only if income was above a certain amount. Okay, so what did we find? I won't go into the research design. Maybe I will. What we found is that for both individuals and firms, if you look at the distribution of reported incomes just over the threshold, there is a missing bunch of returns just over the threshold, which is consistent maybe only with the fact that many individuals and firms reduce their taxable income so as not to have their income disclosed. In fact, we learned, or I learned, since one of my co-authors were Japanese, that any Japanese accountant in the day would tell you that it was a well-known phenomenon to have so-called 39 companies. 39 companies are companies that reported taxable income just below the 40 million yen disclosure threshold. Apparently, so that when they were negotiating with other businesses, the businesses wouldn't think that they were well off and take advantage of them. Same is true with individuals. There's a missing lump of the distribution right above 40. In Norway, the research design is different. Norway's had public disclosure for decades. What changed is that, I think it was 2001, that the publicly disclosed information was on the internet. So it's much more easily accessible. Question, how did the increased access change reported incomes? Now, if we just look at before and after, I don't think any of you would be convinced that I could find the effect of disclosure, since any number of things might have happened about the time when the returns went on the internet. So the research design is, it turns out in Norway, before it went on the internet, in many, but not by any means all municipalities, people would go to the tax office where these were, the information was publicly available for a week or two, copy it off, make a booklet out of it, and sell it as a way to raise money, say, for the local football team. So everybody apparently had this list in some municipalities, but not others. So here's the research design. In the municipalities that already had these books, the change in access when the internet published these income tax data was smaller than in the municipalities where that wasn't true. And sure enough, the data show that the increase in reported income among business people who have some flexibility on reporting, no, they have a lot of flexibility on reporting, was significantly larger when in the municipalities that didn't have those catalogs for sale to support the local football team. The econometrics of multiple tax instruments, well, one is obvious. If you're trying to understand the effect of, say, a tax rate on a behavior, and you leave out all the other aspects of the tax system, like the enforcement regime, the broadness of the base, you're going to, in general, misestimate the effect of the tax rate. You can do that better now that cross-country data on many dimensions of tax administration is available from the OECD. Laura Kawano and I have used this research design to relook at the effect of corporate tax rate changes on changes in corporate tax revenues. And the reason this is important is that you won't be surprised to know that when corporate tax rate changes, more often than not, other things in the tax base change at the same time. And so if you don't take into account when they do and when they don't, you're going to, in general, get a biased estimate of the impact of corporate tax rates. Well, all of these behavioral responses to tax rates are symptoms of inefficiency. This is the lesson of the modern literature on tax-based elasticity. You wouldn't do them if it weren't for taxes, so it doesn't matter whether you spend time at the business school library looking for deductions, or you cut back on your labor supply, or you expose yourself to more risk by evading taxes. All of those are symptoms of inefficiency. And so for the last 10 or 15 years, many of us have been trying to measure the elasticity of the tax base and not worrying about from whence the response comes, whether it's real avoidance or evasion. As Mike mentioned, Emmanuel Saez and Seth Geertz and I have published a long review article about this literature in the Journal of Economic Literature. I won't repeat the results other than the one-line result that our review suggests that the long-term elasticity of taxable income, which is an example of an elasticity of the tax base, but the insight that all responses are symptoms of inefficiency applies to all bases, sales tax bases, payroll tax bases, you name it. But it's very important that these estimated raw elasticities of taxable income must be adjusted for fiscal externalities. What are they? Well, if you measure the elasticity of response to a tax rate of one tax base and don't take into account that part of the response is to shift income to another, maybe lower tax base, you're not getting the sufficient statistic for welfare cost. You have to take into account the revenue gained in the other base. That's hard to do, but even harder to do is if part of the response you measure is a shift to the same base in future years, say by moving your compensation to deferred compensation, to get the right measure for welfare analysis, you have to take into account of the extra future revenue so gained. So I think the focus on tax-based elasticities and elasticities of taxable income is a tremendous development, but before we jump and use them for welfare analysis, we have to consider these two things. Mike mentioned this, and it is one of my favorite papers, so I will mention it again. Unlike an elasticity of labor supply, which we generally assume is based on innate preferences of individuals and can't be changed, an elasticity of taxable income is not an innate preference. It's not a primitive parameter. It depends on primitive parameters, like the elasticity of substitution between leisure and goods, but it also depends on things like how well enforced the tax system is, how broad the tax base is, and so on. What that means is that the elasticity of taxable income can be affected by other government policies. In fact, as we state in the paper that Mike mentioned, in a very important sense, there is an optimal elasticity of taxable income. Governments should set up the other instruments of the tax system so that there is one elasticity that one should use in, say, figuring out what the tax rate should be, and one can be very much misled if one uses an elasticity of taxable income based on suboptimal settings of the rest of the tax vector. Well, I'm not going to talk much about optimal tax systems, other than to tell you and repeat that it raises new questions, such as the optimal auditing structure, how to collect information. The last thing I want to talk about is the proper role of firms in tax remittance, so let me do that. Intermediate textbooks in public finance and maybe graduate textbooks, they all make the following claim. They assert a remittance irrelevance proposition. It's a folk theorem. It's generally not proven anywhere. And that is, it doesn't matter which side of a tax transaction must remit the tax or who is liable for the tax. All the effects are the same. Well, it's just this folk theorem is wrong. It's right in some situations, but it's often wrong. To see why it's wrong, think of why 140 plus countries have value-added taxes, and no country has a value-added retail sales tax over 10%. Our textbooks tell us they're the same. If they're the same, you might expect 70 to have value-added tax and 70 to have retail sales tax. Everybody has a value-added tax, and the answer is there are tremendous collection and remittance advantages of the value-added tax. Why does most individual income tax get remitted by employers? And I'm not sure about what's going on in France. Maybe none of you are either, but it's, last I read in The Economist, the proposal to institute a high top marginal tax rate of 75% got changed to say that the employer must remit this, as if that's going to make a difference. Another example of an optimal tax system question is why exempt small business? The standard model says never do that. It violates the Diamond-Murley's injunction against production inefficiency. But if there are collection costs and administrative costs, for example, fixed costs per firm, this is not true. If there's a fixed cost to dealing with a firm, no matter what the size, you want to take seriously that you might want to exempt small businesses. The cost is you have production inefficiency as the small businesses face different prices than the larger businesses. The gain is that you can economize on the administrative costs of dealing with a smaller number of bigger firms. And as Mike mentioned, in a theoretical model, when you do this, when you have an exemption level for firms, what it does is it pulls some firms that otherwise would be bigger to be smaller to get out of the tax net. And so the theory predicts that you're going to have a missing middle of density of firm sizes. And this is exactly what has been observed and documented in many developed countries. So we now have an optimal tax systems explanation for that. And finally, tax-driven product, innovation. We have lines in tax systems that if in Michigan, if you buy a meal at a restaurant, it's taxable. If you buy groceries, they're not taxable. So we have tables set up in grocery stores and silverware, et cetera, because the tax system has to draw a line between the two. And this causes tax-driven product innovation. I mentioned the car-like motorcycles. I mentioned the car-like panel trucks. And now I've mentioned the tables, napkins, and silverware at grocery stores in the United States to exempt them from the tax on restaurant meals because they're within a grocery store. So let me talk about future directions. I said that taxes are at their core about information. We're having an information revolution, so there must be profound implications for tax. The most obvious is, I think, the least profound, that computerization of the tax collection process is the most visible example of this. But now we can base tax liability on a wider range of information. You all know about the Finnish income-based speeding fines. It's easier to use Akerlof-type tags. I have a paper about how in 30 years tax liability will be based on aspects of your genome. Those of you who are young, mark my words, I won't be here. And smart cards, you can have smart cards so that consumption taxes can be based on a wide variety of personal characteristics. Of course, it works both ways. Tax evaders know about technology. My favorite example is these things called zappers, which is the nickname for automatic sales suppression devices at retail firms in the United States. You put in this software, and the accounting system just randomly deletes cash transactions so that when the IRS comes to look at your revenue, both for sales tax purpose and income tax purpose, they're just not there. They say, can we see your tape? You give them the tape, but those transactions are gone. So let me close by going back to what I started with. Now we understand all these. New types of motorcycle and panel trucks are examples of tax-induced product innovation. Presumptive income taxes based on restaurant tables and square footage rather than income are a more easily measured surrogate tax base that is correlated with income. It's not income, but it's easier to measure. Simplified tax rules levied on businesses below a certain size economize on administrative costs at the expense of production efficiency, which may be optimal in spite of what Diamond and Murley's taught us. that an additional dollar added to its budget will generate $7 in additional tax revenue says nothing about the wisdom of increasing its budget. I didn't mention that in my talk, but the simple answer is it's apples and oranges. The money taken in extra tax collections is a transfer from you to the tax authority. The computers and analysts that the IRS hires are a real resource cost. I just told you about the difference between a VAT and a retail sales tax. With limited withholding and information reporting possible, the self-employed, especially those operating in cash businesses, are the final frontier of tax compliance. And you now know why you are now interested in what my kids couldn't have cared less about in Puerto Rico. So the insights, Frank Hahn once wrote that optimal tax formulas are either guides to action or nothing at all. I've argued that as of now, these formulas mostly refer, not all, mostly refer to a stylized world that is far from the reality of withholding, information reports, tax havens, and evasion, and where line drawing and notches lurk everywhere. The promise of tax systems analysis is that it applies rigorous economic analysis that was introduced 40 years ago to the sorts of issues that are prominent in the formulation and implementation of real-world tax policy. Thank you very much for the honor of me delivering this lecture. Sorry, I went a little bit over.